Good afternoon, everyone. Thank you for joining our fortnightly session on tax advice, and I hope you are starting to enjoy our sessions. One is on tax investigations during the month, and towards the end of the month we have a tax planning and tax advisory session. My name is Jamal Khan. I'm a senior tax partner at Churchill Tax, and we've got Hazel Johnson, who's the tax director. Hazel is a tax barrister, a lawyer, and a specialist in tax matters. Without waiting, we've had some feedback that we should start as soon as we can, so therefore we are starting. Today's topic is some more tax planning tips, which are becoming quite popular. Properties, and Hazel will be doing the presentation. If you've got any questions, please do send them through the messaging box, and we will answer them for you. Or if you've got any questions at a later stage, you can email Hazel at h.johnson@churchill-tax-advisors.co.uk. You can email me at j.khan@churchill-tax-advisors.co.uk, or you can call us on 0207 998 1834. Over to you, Hazel.
Okay. Okay, so my topic this week is going to be family investment companies. But first, a little bit about Churchill Tax Advisors. So we're a specialist tax advisory firm based in London and Essex, and we offer national coverage. We specialise in tax law, including income, business and inheritance tax planning, tax investigations, dispute resolution and tax tribunals, Code of Practice 9, Code of Practice 8, and POCA investigations. We also do VAT and stamp duty planning, capital gains tax planning, UK and offshore trusts, and disclosure of undeclared income. So as I say, what I'm going to talk about today is family investment companies. So I'm going to talk about the why, the what, and the how of them. So why would you want a family investment company? So broadly, you would want to start an investment business, or you already have some investments. You're thinking about inheritance tax planning and bringing your children into the business. And the problem that you broadly face is that there are no trading reliefs on investment businesses. So trading businesses are treated more favorably by the tax system. So they can qualify for what we call gift relief for capital gains tax purposes, and business property relief for inheritance tax purposes. So what is a family investment company? And in many ways, it's just a fancy name for a basic company, but it's about what you're doing with it that matters. So it holds your investment assets. You are currently facing a 19% corporation tax rate on both income and capital gains. And this allows you to roll up your investment assets in the company at a 19% effective rate of tax, as opposed to 20 or 40% if you were holding them personally. Now, this does come at a price that you can face additional tax on withdrawal of profits from the company, because you could be taxed either as receiving a dividend or a salary. However, if you have funded the company by way of a loan, then you can use your director's loan account to draw funds out of the company in a way that doesn't attract additional tax. So at least to start with, that's a very attractive way of extracting funds. And of course, that also will feed into what I'm going to talk about later on about the inheritance tax aspects of such companies. So the sort of special tweak that you give to a family investment company to make them effective for inheritance tax planning purposes is the creation of additional classes of shares. So you can have as many classes of shares as you want, one for each member of the family who's a shareholder in the company. And the aim of these shares is that they reflect the future growth of the company. They don't generally have voting rights, so the person, the patriarch or matriarch of the family, can maintain control of the operation of the company, and can perhaps think about giving voting rights to children as they sort of get older and mature as part of a process of handing on the business. But over a period of time, because the other shares reflect the future growth of the company, as the company grows in value, this will shift value to the younger generation. And it's done in a way that doesn't attract capital gains tax or inheritance tax. And because the loan account is there, it can be used to still fund the parents who've contributed funds or assets to the company, but this declines in value over time. So the combined effect of this planning from an inheritance tax point of view is that when the family investment company is initially created, the value of it is reflected both by the loan account and the existing shares in the company, which are effectively worth nil in many ways because the existing value of the company is offset by the loan account, and future growth in value is held in the other shares that you've created. And at the time they've been created, they have no value for either capital gains tax or inheritance tax. So the creation of them and the transfer of them to the children should trigger neither capital gains tax nor inheritance tax. Though obviously this is a finely balanced process and a lot depends on how you are drafting these shares and how you are altering the memorandum and articles of association. So how do you create a family investment company? Ideally, you would be in cash, because if you are transferring a loan into a company that's cash based, then there's going to be no capital gains tax on the lending in. If you are having assets that you already own, then you're going to have to look at your capital gains tax position, because if those assets are standing at a gain, if you transfer them into the company, even by way of loan, there is that's going to trigger capital gains tax. And as I say, the point is to get a loan account in return. So if you fund the company to the tune of £1 million, you have a loan account that's worth £1 million in your name. The company has assets of £1 million, but that is offset and reduced by the loan account of £1 million. So the company is effectively worth nil at that point. As I say, when you're running the company, it behaves as any other normal corporation. So you're paying 19% corporation tax on income and gains. And then you are drawing down profits as the sort of the matriarch or patriarch, as I say, you're drawing down profits through the loan account. So this will allow you to extract funds from the company in a tax efficient way. And hopefully you've set this company up in such a way that this will be enough to see you through to post-retirement and post-old age. But if not, you still have the option of taking either dividends or salary out of the company, and that can still be reasonably cost-effective taken over the lifetime of the company. So getting to sort of the final position for inheritance tax purposes, on death, the ideal position that you would have reached is that the loan account has been exhausted. So you, as the creator of the company, will have no loan account in your estate. So there'll be no inheritance tax to pay on something because you don't own it any longer. Most of the value of the assets is going to be contained in the other class of shares that your children own. And you will have a reduced value in the original class of shares, so that even if you are paying inheritance tax on them, it will either be at a reduced rate or will be within your nil rate band. And certainly, as time goes on, if you feel that you want to, you could make a transfer of those shares, even though it may attract some capital gains tax. That's always a sort of a plan B option that you can come to in later life. Or you could tweak the classes of shares again and transfer value even further into the other classes of shares. Although that's a more problematic and difficult planning to achieve, and something that needs to be considered very, very carefully. So in summary, the whole point of a family investment company is that it will allow you to manage the family portfolio. So in many ways, a family investment company can take the place of a trust. In the old days, when trusts were not as tax inefficient as they are currently, you would be able to pool assets for a family. You would be able to decide who would be able to get income, who would be able to get capital gains. And you could use it to mitigate your inheritance tax position by making gifts of your sort of share of the underlying assets for inheritance tax purposes. And a family investment company allows you to do broadly the same thing, but in a much more tax efficient way. Again, it allows you to roll up at reduced rates of tax. So instead of paying 40% on income drawdown, or 20 or 28% on capital gains, you will be paying the company will be paying 19%. And over the time, with sort of the effect of compounding, those savings can become really quite important and allow you to generate a lot more wealth. It makes your portfolio work a lot harder for you. As I say, it allows you to undertake inheritance tax planning, because you are transferring assets to your children in a way that's tax efficient, but it also allows you to keep control of the company by having the voting shares, so that you can allow your children to be blooded into the family business. They can experience the opportunity to make investment decisions, being involved in the management of the assets, and be included in that whole process, and have an opportunity to find their feet, but in a way where you have still kept control of the assets. And because you have the voting shares, if it comes to the point where you want to exclude participation, there are possibilities as the way to do that. Although it must be borne in mind that with a company, there are all sorts of minority interest rules that can affect how you can treat people with different classes of shares. So that is a big difference between having a trust, where it's just the trustees considering the interests of the whole of the family, whereas as the person who is running the company, you can't ride roughshod over minority interests, although you still do have an enormous degree of control. So it's a very useful strategy. It's normally used, as I say, in the cases of portfolios, but it does also allow opportunities for people who want to do this kind of planning with a buy-to-let portfolio. There, you would have to consider very carefully about how you were going to transfer any existing assets into a family investment company, but certainly if you had cash spare, you could fund the deposits for any buy-to-let properties by making transfers and loans of cash to the company. That company could then go out and invest in buy-to-let portfolios. And your children, as I say, could be involved in managing that business and learning how to run that business. And over time, the capital value of those assets will increase, and this will be reflected in the other classes of shares. You will be able to draw down your initial contribution to the business by way of your director's loan account. And you will also be able to pay the 19% corporation tax. And you will also not be facing the Section 24 finance cost restrictions on interest, certainly under the current rules. So it does offer a way of introducing your children into the buy-to-let family business as well. And coupled with other planning that we can discuss with anybody about how to fund a company or transfer your existing portfolio into a company. This does allow sort of a powerful technique for shifting value down through the generations. So, as I say, we are chartered tax advisors. We specialize in all kinds of tax planning, but particularly property-based work. Jamal is a chartered tax advisor. I am a tax barrister and lawyer, and between us, we have an awful lot of experience in this field. And we're always happy to help any client who comes to us with issues to do with their structuring.
Thank you, Hazel. That was brilliant. I think I have seen a lot of inquiries about family investment companies recently, and as we send a recording of this presentation to our wider audiences, which is about 50,000 people, I'm sure we will get a lot more. But the main questions I have received are around: is there anything that can be done with the existing equity the parents have in the company? Because say somebody wants to start a family investment company with an equity of £5 million and wants to bring their children in, does that go some way, or do you think you've got some better structures that can address that situation?
I mean, that's always going to depend on the individual circumstances of the people involved, but certainly a family investment company structure can be created at that point. The difficulty can be that if you're doing it with an existing company where you don't have a director's loan account, all you can do with the family investment company shares and creating an additional class of shares is shift future value and future increases in value down to the children. And if you've got a company that's worth 10 million, yes, if it sort of doubles in growth over the course of the next 5 to 10 years, you will be able to take, say, £10 million out of your estate. You're still left with that original £10 million in your estate on death, and you're going to have to think about how you're going to deal with that. And at that point, you may have to think about gifting some element of your equity away, which is going to have capital gains tax consequences. Or you hold on to those assets until death and you pay inheritance tax. There are more complex strategies available to allow you to shift the value of that company down to the younger generation. But they are, and we're happy to talk about those with people as well. So you can sort of combine that with other strategies to give you the best overall result. A lot can depend on what the assets are in the company.
Great. I think that's a very good answer, Hazel. And it's there's a misapprehension in the market, or misconception in the market, should we say, that if you set up a family investment company, you're not going to have any inheritance tax problems at all. and then that needs to be taken with a pinch of salt. Same as I think when people start to, when we get a lot of landlords who have heard somebody speaking in the pub or down the golf course that we should put all our properties into a limited company. And I say, and then what will happen? And then they say, well, somebody told me to do it. So it looks sounds like a very good idea. I said, but what about your inheritance tax? And they say, well, no, we haven't thought about that yet, have we? What about capital gains tax? What about stamp duty anti-avoidance legislation? Section 7A. So a lot of people do a hearsay on tax planning. And in fact, I had a client from, Bart, and very, very adamant. We were very interested in tax planning. He wanted to put all the properties into a limited company because his mortgage advisor suggested that he should do so. And he was having an argument with me on why he should do it. And I said, but why should you do it? But what about your inheritance tax? He said, well, my mortgage advisor is not an inheritance tax specialist. So that's something that you've got to be very, very careful with. Excellent. Okay, well, thank you very much. Unless, let me check if that was the main question that we had. Thank you very much. And if you've got any questions, I've shared our details. You can on 0207 998 1834, and you can ask to be transferred to Hazel. Thank you very much. Thank you, Hazel.
Okay.
Thanks.